Hi, this is Lex, and welcome to the Fintech Blueprint. It's your podcast about fintech, decentralized finance, digital banking, investing, robo-advice, artificial intelligence, and all the other frontier technology that is transforming financial services. To get more content, like an illustrated transcript of this conversation in your inbox, subscribe at fintechblueprint.com. So without further delay, let's jump into today's episode. Hi, everybody, and welcome to today's podcast. It's going to be a fantastic conversation, and I'm absolutely thrilled to have with us today Steve McLaughlin, who is the CEO and founder of FT Partners, the premier financial technology investment bank, and Jon Lear, the president and co-founder of Fintech Meetup, which is the leading fintech conference in the world today, as well as Jon having fantastic operating experience across the space. With that, Jon, Steve, welcome to the conversation.
Hi, Lex. Good to hear you.
Yeah, thanks, Lex. Thanks for having us on. And Jon, always great to connect and partner with you on new adventures.
Absolutely. Looking forward to it, Steve.
I feel like we've got kind of like a black hole of gravity of fintech community right now. We probably are covering 90% of the entire fintech network by having the two of you here.
Only 90? Come on.
We've got some work to do.
Fine. 200, 300%, 100% for each one of us. Okay, so before we get into all the market trends and what you're seeing today, I want to open up the themes of early fintech, because both of you have been in the industry for a long time, as well as understanding kind of your founding experience and your sense for what this was like in the beginning. Steve, maybe starting with you, can you talk about the early parts of your career when you just started doing banking around fintech companies, your experience at Goldman, and then taking that jump to found FT Partners? Tell us about what motivated you to do that and what the environment was like at the time.
Sure. Thanks, Alex. Yeah, I'm going to go back in the Wayback Machine of my life here. But in 1995, I was a young 25-year-old, got a job at Goldman Sachs in New York City in their financial institutions group, which was the preeminent FIG group on Wall Street. I mean, these guys were pretty amazing. They were doing every single major transaction around the world, and sometimes on both sides. Goldman was a private partnership, really wasn't a public company. I got thrown into this FIG world of working on big financial institutions M&A. Well, 95 was about the time where the internet started becoming a thing in the mainstream, and you started seeing all sorts of companies popping up with, no revenue and huge potential. The internet was seen as, the next big, huge thing, right? Interconnecting everything, being able to, transact across multiple computer networks, right? And so, there's theories that you wouldn't need bank branches anymore. You wouldn't need insurance agents. Everything would just be done online. And oddly enough, all of our big CEOs, from, Jamie Dimon to Hank Greenberg at AIG to many others, were definitely nervous but excited about what was going on with this sort of fintech world. And actually, probably worth pointing out, the word fintech did not exist back then. It was things like e-finance, iFinance, finance.com, the .com world of financial services. The word fintech was never even uttered my entire time at Goldman Sachs, oddly enough. So I was always kind of an entrepreneurial guy, raking leaves and shoveling snow and painting fences, when I was a kid. And I saw this .com stuff going on, and I said, I really want to work on that. And it turns out that I was the only person that said that. Nobody else really wanted to work on this space. And I got sort of stuck putting together these 150-page books for the big CEOs saying, here's what's going on in your space, in the banking space or the insurance space or payments or whatever. That turned into me sitting in a conference room, meeting hundreds of these entrepreneurs coming in who had a lot of hope, no revenue, but were looking to raise money or do something or other. And back then, it took way less traction to get attention than it even does today, believe it or not. The measurements were how many eyeballs on your website, how many people visited, how many people signed up for an account. These were huge metrics back in the day. So I ended up meeting hundreds and hundreds of these companies and ended up actually really understanding the space, more than anyone else at Goldman, that became my sector. And so there was a few other senior people that were overlooking it part-time. It was the number one thing I was working on from basically 96 or so to 02 when I left. So, and I won't go too much longer here, but in the early days was .com everything. People tend to think this last fintech boom was like the real rise of fintech. I mean, there was conferences, for mortgages that were, half the size of Fintech Meetup or, Money 2020. And there was huge internet conferences for financial services, and it was a boom. I mean, companies were worth billions of dollars, on almost no revenue. So it was really, really riding high. And then, of course, it crashed hard. There was a fintech moment back in the .com days. It was, seemed as big as it was recently, but I don't think it was as deep because the definition wasn't as wide.
Everything that's new has happened before, from the pitch that you described in 95 about getting rid of branches or underwriting online to the boom cycle to the collapse. I'm curious, just to stay with it for a moment, some of the companies that you worked on in that period, like 98 to 2001, 2002, were there any companies that persisted, that remained and turned into big brands in digital financial services today? On the flip side, maybe were there things that you thought, oh man, this is such a great play, but they didn't make it through the internet cycle?
Yes and no. I mean, if you think about some of the institutions like the New York Stock Exchange and NASDAQ, I mean, they were sort of paper-driven businesses that transformed into electronic businesses, right? But they were always very tech-driven. Mastercard and Visa, clearly, these were all private companies, associations, member-based. And they weren't worth very much money back in the day. It was very unclear what NASDAQ was worth. I remember when Goldman and I was there, we made an investment in NASDAQ. It might have been around $1 billion. And everyone was like, what is this thing? It's just, it's just this little network of friends trading, and it wasn't really seen as what it could be today. Same thing with Mastercard and Visa. People forget the valuations of those companies were sub $5 billion, way below that in the late 90s. As a matter of fact, Mastercard went public in 07 for $5 billion, right? Believe it or not. But those are the ones that were already existing and big brands around the world at the time, but they became much more massive, bigger brands over the course of time. The companies that were unknown, like X.com and Confinity, later became PayPal. You could say that in 20-something years later, they became big successes. But the truth is, for all the money they raised, it was hundreds of millions. And Goldman itself did raise a bunch of their money. They sold the company for just over $1 billion to eBay. They kind of, in a weird way, kind of gave up on it 20 years later after eBay, incubated it and, kind of then shoved it off into the public world again. It became worth, 100 billion plus or minus, depending on when you look at it, company. But no, there was, and maybe if you look back at the ETrades and the Schwabs, they became pretty big deals over the course of time. Schwab, obviously today, pretty mega company. And then probably last but not least in my quick list here anyway was Intuit. Intuit was a sleeper in the early days. They were the small software company selling QuickBooks and Quicken. You could walk into a Staples and buy a box of Quicken, a CD-ROM or whatever. And they've turned that thing into the huge empire of SMB and consumer tech, and I love the story of Intuit. And it was around back then, of course, and no one really talked about that much. And without making much of a peep at all, turned into a $200 billion company during this fintech boom. So no, it wasn't that many companies, but there's a number of them.
It's fascinating to see who gets there. In 2023 or 2024, we're sitting here and things like 1inch and Uniswap, Aave are under $1 billion or in the single billions. And people are looking at them and saying, that's a weird network of people trading with each other. But over a long enough time horizon, I think we'll see a lot of analogous growth. Jon, switching to you and that early part of your career where you were a fintech entrepreneur, how did you come to the sector? What brought you in and what was your experience like?
Yeah, so I guess my path fintech was slightly different to Steve's, but I started my career off actually as a consumer marketeer at Procter & Gamble. So working on, really glamorous brands like Pampers and Sunny Delight, the great stuff kids sometimes went for. But about 5 years after being at P&G, I kind of had this entrepreneurial hankering, just much like Steve, wanted to go off and do my own thing. I just started looking around, and this is way back in 2006, 2007, again, before fintech was a common phrase. I came across this little company called EarthPort, publicly traded, raised a bunch of capital out of London. And EarthPort basically did cross-border global low-value payments. And it was an idea way ahead of its time. But I was captivated by this. I've been spending a lot of time traveling, going back and forth between London and Asia and London and the US. And it's a bit of a cliche, but it was absolutely right. Back in 2007, it would take you 3 to 5 days to transfer money cross-border. And EarthPort, this little publicly traded company, it could do that in less than 24 hours. So I just got absolutely captivated by this, what was a fintech, and said, hey, there's a real opportunity here. And I guess I saw a couple of things happening just on the macro side, which really reconfirmed my thinking. One was just globalization. It was clear that trading flows were going to become more and more global. The second was that there was definitely much more migration. And then thirdly, just as Steve was saying, the rise of the internet, marketplaces, cross-border commerce, those three things all said to me that this was a fantastic opportunity. So I bought a one-way ticket, packed a bag, moved to the Holiday Inn in Chelsea, and then over the next 12 years, built out the business for EarthPort, really targeting 3 or 4 different verticals: financial institutions, e-com marketplaces, and consumer remittances. It was, just such an incredible experience, beating down the door every single day over the course of 12 years, really evangelizing about financial technology, why we could do things that Citibank couldn't do, or JP Morgan couldn't do, or Bank of America couldn't do. In the early days, everybody thought we were completely nuts. Why on earth would I use a relatively lightly regulated financial technology company out of London with a market cap of less than 100 million versus Citibank with, multi-billion-dollar market cap and thousands and tens and thousands of technologists everywhere? But ultimately, that evangelizing worked out and played out to our advantage. And we almost became the kind of de facto global low-value payment rails for a lot of these financial institutions. In fact, I think by the time we'd actually sold the business to Visa, I think about 12 out of 15 of the global banks were actually using EarthPort in some way, shape, or form. So those early days were, a lot of evangelizing, a lot of explaining what is fintech, how can we help, why does it make sense to partner. It was just terrific fun. Right back in those early days, there was a real collegiate feel to the industry and to the community, people wanting to help each other, tremendous levels of excitement. And that's something that we're recapturing with Fintech Meetup, which I know we'll come on and talk about. So that was my EarthPort chapter. And then after that, I moved to JP Morgan, ran the Fintech Partnership and Network Group for the Corporate Investment Bank. So that was really on the other side of the transaction, which was, hey, as a big globally regulated institution, how do I go around the world? How do I identify fintechs that we can bring into the shop and that can help us augment our existing products, bring solutions and services to the market? So it was there for about 3 years. A lot of fun working in a regulated environment because you completely see the other side of the coin. And then we launched Fintech Meetup in January 2021. So Fintech Meetup is being really for me, has been the good culmination of the marketing side, the fintech side, and then the banking side as well. Again, been terrific fun building out what is now one of the biggest fintech events globally in the world.
One of the things I want to do is just kind of get a tangible handle on the word fintech, the market size, how it's changed over time, the amount of capital that's come in, the community that's grown, and so on. But before we get to that macro question, I want to pick up on a thing that both of you said in your experience around these use cases that came up decades ago. And the use cases that come up to me seem like they are timeless. It's the same pattern that recurs in terms of what people need. You have a footprint of payments and you need to be able to pay in some permutation of consumers to businesses and geographies and amount sizes. You've got banking and lending for money at rest. And then when the money gets really tired and at rest, then it goes into investment management and asset management and then retirement and insurance and so on. You kind of got these repeatable patterns. And what boggles my mind sometimes is that you end up in these cycles with companies that are pitching the same value proposition, right? Like, how is it that Ripple exists in a world where EarthPort solved cross-border payments, or how Wise ended up taking the position in the consumer cross-border market when EarthPort and I think a number of others were there as well, or how is it that we're still trying to figure out best execution for, let's say, the crypto markets, or in different parts of the world where the fund admin platforms aren't that mature, when in the early 2000s you had the stock exchanges come to fruition. And I want to throw this question, I guess, to both of you. Why don't these problems get solved? Like, isn't it, if it's so obvious what the issues are, and then the companies that go against those problems, quote unquote, win and build multi-$100 billion market caps, why is it that we're still finding the same problems over and over again?
Well, I'll say this is one of the things I love about, financial services and fintech, which is a derivative of that, obviously, is, 99 point something percent of financial services is just, digits, right? Already, right? I mean, at the end of the day, JP Morgan's a big bank with a lot of big buildings and desks and branches, all this kind of stuff. But the products are all, virtual, right? You don't see a loan on a shelf. You don't mine a loan, right? And so it's when you have things that are digital as a core product to begin with, right? There's really no end to the level of innovation and improvement you can have. So while you think that, there's been no improvement, there's been a lot. There's just always a much more you can do. So at any point in time, it feels like you've got all these huge problems that can be solved. I mean, at least at the moment, you and I can go to ETrade or Schwab and trade 100 shares of, Apple for $7, right? That used to be $150. So there's been a lot of things that have been solved. Auto insurance, you can get a quote even at Geico, and they say 15 minutes, but it's really 5. So a lot of problems. It's just everyone wants to dig to the next level. So that's really the reason I love fintech. It's just people keep saying, "Oh my God, is fintech dead because the market's down, or we're in the second inning?" I think we're always going to be in the second inning of it, and the opportunities are massive. I mean, even if Ripple becomes a $1 trillion company, or Worldcoin becomes a $1 trillion company someday, there's still going to be problems with moving money around the world and identity, probably, right? So there's always another mountain to climb, in my opinion.
Yeah, I agree with you, Steve. And, using the EarthPort story as well, I think we were faced with a very interesting question, Lex, which is, which market do we want to serve? Do we want to go the infrastructure route and basically sell picks and shovels, i.e. sell to the banks? Or do we want to go build an SMB or a consumer proposition? And we'd have probably got, we think, a much, much richer valuation if we'd have done the consumer side and tackled it much like Wise did. Ultimately, we went down the infrastructure route. And I think the learning for us was, long term, that probably would accrete as much, if not more value, versus a sexy consumer-facing brand that everybody can immediately wrap their minds around. But it's going to take much, much longer. So that's where I think you've seen, a player like EarthPort establish themselves, really redefines the infrastructure. But when you're talking about changing infrastructure for big global banks, big money movers, as opposed to launching a complete greenfield consumer proposition, you're talking about, changing institutionalized behavior, which, we think takes 3 to 5 years to get flows of any real size. So the challenge with the infrastructure situation, and this is why I think to answer your question, why you've had so many people keep coming into the market to tackle the same issue, is that one, it takes a lot of time, and two, it actually takes a lot of capital as well. Building and cultivating these relationships, it might be a 2-3 year sales cycle, might be the same again to actually get them up to maturation in terms of payment flows. So that's where I think you see people looking at it going, hey, there's still a fundamental problem here to be solved. Whereas actually, I think the insight is that there are players out there who solved it, but then it's really, how do I get to a scale challenge in question?
I also think of it as kind of these generational flips that create institutional structures that are functional, but then you have new platforms of technology coming back to the same problem and solving the same problem in a slightly different way with a different set of tools. And so we do now have these labels, from financial services to e-finance, electronicfinance.com, to the Web2 consumer wave with the Fintech label, to now the blockchain, crypto protocol, DeFi wave to the AI wave, all rolling the ball forward. And I want to double click on the word fintech and whether it actually holds any meaning anymore. Like Steve, you said, fintech is a subset of financial services. And I also wonder whether there is any part of financial services that's not fintech. There's such an effort by the banks over the last 5 to 10 years to role play as technology companies. And I wonder whether the fintech DNA hasn't sort of already been absorbed into the industry. If you were to draw boundaries around the fintech industry, and this goes to Fintech Meetup as well, what are those boundaries? Are there things that are excluded on the traditional financial services side? Are there things that are excluded on the next generation of financial services on chain?
Yeah, it's a good question. We think about it all the time. I mean, I think there's some part of the world that thinks that fintech is only small, super high growth companies, and that's just, by definition, if you're small and hungry and raising VC money, then you're doing something in tech and financial services, that's fintech. From our perspective, there's a much, much wider definition, which is if you're using technology to disrupt financial services, or your whole business is based on technology and financial services, right? And maybe you're not a disruptor, maybe you're an old school company. So, question is, when ETrade sold to Morgan Stanley, was it a fintech company or was it just like a normal online brokerage company that there's like 50 of, and therefore it's not really super disruptive? I mean, and you don't have to even answer the question. It is what it is. I mean, they're a purely online, no branch or, very few branch online broker. So from our perspective, you could be a 25-year-old auto insurance claims processor, but if you're processing, electronically auto insurance claims, you're a fintech company and we'd be happy to work with you, right? But then you could take that to the extreme and say, well, is JP Morgan a fintech company? Is Goldman Sachs a fintech company? And they would say that they are, tongue in cheek, but they're really not. So I think there's a blended gray line somewhere between, if you're, a very big old school financial institution with a lot of balance sheet and, thousands and thousands and thousands or 100,000 people, you're probably not fintech. But, so I think it's quite complicated. I think, when we think about the blockchain space and crypto, some of that space is fintech, some of it's not. If you're, purely selling NFTs online, I'm not sure that's fintech, but if you're the company that's processing the payments on the blockchain for that company, you probably are. So really blockchain is, and crypto are sort of, part in, part out. But things like healthcare, a lot of people don't think that healthcare is fintech, and a lot of it isn't. If you're a bioscience company or if you're making software for ambulances, you're probably not. But if you're in healthcare payments, healthcare lending, revenue cycle management, we actually call that fintech. A lot of other people do not. If you're in prop tech, parts of that are clearly not fintech, but parts of it are, home improvement lending and all this kind of stuff, mortgages and title and escrow. And so beauty is in the eye of the beholder, I suppose, in terms of definition. And I don't think there's ever going to be a perfect definition of it. But one thing I'll say is the market size of fintech has been perceived as being pretty large, is partly that a lot of people wanted to put the moniker of fintech on themselves, right? If you were doing procurement software, 10 years ago, you probably weren't trying to call yourself a fintech company. These days, they are. They're doing 99% procurement and 1% payments. They want to be called a fintech company because fintech was, quote unquote, hot at a period of time. So I think the number of firms or the number of sectors that wanted to be included in this fintech boom expanded a lot. The definition is definitely kind of squishy, I would say, but it's always in the eye of the beholder. And for us, it's a pretty wide one. John, curious your point of view.
It's something that we thought about a lot because, I think our view is that fintech in the traditional sense of the word, it's actually sounds pretty constrained. At Fintech Meetup, what we did was we created a taxonomy, which basically identified 130 different categories of solutions and services. We think it's pretty exhaustive. And that covers everything from issuer processing, blockchain, DeFi, digital assets, cash flow management, all the way through, right from A to Z. But the more that we're thinking about it, the more that we actually think there's an even more expansive view on that. And we actually think that anything that is somehow tagged to money it falls within the definition of fintech. So that obviously covers things like insurtech, as Steve says, prop tech, healthcare, all the way through from banking, obviously payments. And even if you take the view that, look, if there's value attached to a transaction or to a relationship, that falls under fintech. That even holds true for things like data and analytics. So somewhere a customer has a relationship, which is financially based. There's data and analytics work around that. And that's obviously falls within what we would call kind of broad, very, very broad fintech. So we take a very kind of maximalist view of what's in fintech because we think the boundaries and the kind of segmentation and the lines are getting more and more blurred.
I think it's one of the definitions of fintech is what makes it hard for very large investment banks to cover the space well, because, you've got all these other definitions, right? There's a software group at Goldman Sachs and JP Morgan and Morgan Stanley, right? And when a high growth software company comes into play, like a Coupa or an AvidXchange or somebody, right? They want to kind of claim it, but then the fintech group may want to claim it as well. So there's all these sort of like battles. When Square became a hot topic, that was in tech group, but like Global Payments was in the FIG group, right? Or the East Coast fintech guys. There's all this territorial kind of infighting, and that's one of the reasons I split off from Goldman. Is that I thought the space needed to be fully defined and have someone out there that was like really, really focused on it. Whether it was a super high growth company or a lower growth company, all the payments domain was with us, right? And so same thing with stock exchanges. You could cover New York Stock Exchange. You need to know what's going on with all the upstart companies as well. You can't just have a bunch of old school guys covering all the big exchanges and a bunch of, kind of younger hotshot bankers trying to cover the upstart companies, right? Because those two worlds, they really do collide. You got to know both. And that was always the thing for us. We kind of covered everything in fintech. Yeah. So there's turf battles inside bigger companies around these things.
One framework I've had is there's a distinction, and this goes to what Jon said about kind of economic value and touching money. There's a distinction between different parts of the economy, and that can be pretty closed loop, or at least, very self-referential, where, for example, the creator economy, where people build things for YouTube, or Substack or TikTok and figure out ways to connect into Shopify and monetize that. Or, alternately, the Web 2 economy that was built out of the mobile apps, so the Ubers and the Airbnbs of the world that created an economy out of the iPhone, or the early credit cards, the restaurants that accepted early credit cards, or if you now look at the crypto networks, the economy for the goods and services that are provided there. And so those are kind of, you can think of them as circles or as ecosystems. And of course, there's flows in and out, but they tend to have their own logic and rationale. And then once you have the pocket of GDP kind of growing out on a meaningful platform, right? Like the platform of the iPhone or the platform of YouTube or the platform of blockchain networks, you then need venues for financial activity. And it's not mysterious what financial activity you're going to get. You're going to have payment networks, you're going to have capital markets, and you end up having these overlapping ecosystems of, you've got this economy, it's using a little bit of the old infrastructure and venues, but then it's developed completely new infrastructure and venues to do things that have been needed in the past in a new way. And so you end up with things that are redoing the same use cases, but in different parts of the world and on different stacks. And it's just a way that I think you can separate out the value creation.
Well, by the way, on that point, I think what's interesting and what we've seen is, companies that try to do too many things at once and don't really rely on existing infrastructure that much have a really hard time. And it's the companies that are riding a trend, but they do one thing really well that's new, but everything else they do is riding infrastructure, right? And so take like a Stripe when they first came out, right? They saw obviously that, mobile apps were going to be big. The big old school payment providers couldn't really move quick enough to, adapt to a developer friendly world. And so they said, hey, we'll use payment tech as our back end, right? But we will create a very thin 3 lines of code type of developer friendly, open integration type of platform that makes it really easy for the guys at Airbnb or Uber to offer payments on their mobile apps and websites. 99% of what they were doing was technology had been around for a long time. And a lot of people didn't even understand that, right? That, oh my God, this guy's at Stripe created this huge payment processing full stack engine and da 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 da. They really didn't, right? Same thing with Square. I mean, they didn't create a payment processor, right? They said, okay, there's an iPhone, there's payment processors, there's fraud solutions providers. Let's use all this existing stuff and let's create this little 99-cent dongle you stick in there and it can read a credit card and boom, you got Square. So, but we've seen some other companies try to do literally everything, right? And it takes far too much money, far too much time. And, you end up spending all your money on building all this tech and you have no money left for advertising, right? And so that's one big mistake I think we see people make. And the other one is, I think it's very, very hard to build a consumer brand. And let's just say, at least in the United States or any country in the world, because the incumbents are spending so much money, right, to build their brands. They've been around for 100 years. So try building an online direct-to-consumer auto insurance company like Root or something like that. And it just becomes nearly impossible because you're competing with people that are spending 20, 30 billion a year and you're spending 200 million a year on advertising. And so, the product isn't that good that you can get away with just spending $100 million on advertising and it's going to go viral. So, that's another, big, I think mistake people have tried is like, let's go try to create a consumer brand. So what we're seeing these days is almost every business being created is more like a B2B to C model for consumer. Oh, let's leverage, every grocery store in the country. Let's go leverage Walmart. Let's go leverage XYZ to get to the consumer. We have a client, Daily Pay, who's, doing earned wage access. Well, they're going through Walgreens and Kroger and all these big, employers to get to the employees, if you will. And they're like one of the fastest growing companies in fintech right now. So, you're seeing, leverage other things that already exist within the world, the ecosystem, and do one thing really well to get to that consumer, but don't try to do the brand new technology and advertise to the consumer. That's really hard. So, I mean, unless you really, really want to be super ambitious and can raise billions of dollars, that's fine too, but that's very, very hard to do. So anyway, sort of hitting on your ecosystem question.
We do have Coinbase and Revolut, which I think you guys did, and Robinhood and SoFi that have kind of survived the market crash and are, from an operating perspective, are doing quite well. But my question would be, looking forward, what is that market environment like? And Jon, maybe you can share the vibe in the Fintech Meetup community, because usually conferences can be a barometer for the health and risk taking of the entrepreneurs and investors in that community. What are you seeing happening in terms of engagement? Is it the B2B2C thematics? Is B2C consumer fintech slowed down? What's the temperature?
The first thing is Fintech Meetup. We kind of approached it in a very different way to other conferences and events. Obviously, what we do is we bring together everybody from right across the whole ecosystem. So payments, banking, lending, credit, crypto. And we really focus on how do we enable everybody to have these great conversations through what we call Meetup, which is our meetings program. Meetup itself, it's pretty phenomenal. If you haven't experienced it, we ended up scheduling about 30,000 meetings at the last Fintech Meetup, and we'll probably do 40 to 50,000 at the next one coming up March 3rd to the 6th. So that whole piece around getting into conversations, creating opportunities, seeing who's talking to who, we get a really good sense of what's happening in the ecosystem and across the industry. And, I would say right now, there's a very, very interesting dynamic happening. And that dynamic is basically heads down. We got to get back to building. We've got to not worry so much about valuation. What we've got to do is we've got to ship customer meaningful product, customer meaningful innovation. We've got to create partnerships that add real value, and we've got to exit the ones that are just a drag on our business. So it's a real get back to building, get back to grinding. And so far, I think that's why people are going to Fintech Meetup. It's the place that you go to get business done, whether you're looking to create new commercial opportunities, whether you're looking to create partnerships, whether you're looking to see what everybody else is doing across the industry. I was at a dinner a few weeks ago with Roy and Bertrand Souza, who, Steve, you obviously know very well from NetSpend. And they think that fintech is in a really interesting place, which is, look, too many people have been worried for too long about the valuation side of the house. But actually what they really need to do is go back to basics, looking at the P&L, looking at the cost structure, seeing how they can tweak the margin, seeing what they can do to create more profitable mix effects. That coming from somebody who's been so experienced and so successful in the industry, I think that's the pulse we're getting. One thing we are seeing is we're seeing a bit of a pullback on the consumer side, but we're seeing a lot more traction and a lot more interest on the infrastructure side. And that could be infrastructure in terms of payments, reg tech, blockchain. So definitely on the infrastructure side, whilst it's always a harder path to nail, it's certainly one where we're seeing big institutions showing a lot more interest.
There are some parts of the consumer world that are completely risk on already. People are buying NVIDIA stock through the roof. Big tech has largely recovered from its slowdown last year. There are ridiculous meme coins on Solana that are generating billions of dollars of market cap. And so some of the places where I'm looking, I'm getting nervous how excited or how frantic some of the entrepreneurial activity has become, to a point of, have we learned any lessons in the last 2 years? And are we really back in a risk-on environment where everyone is surging forward? Steve, what's your sense for maybe the more mature capital markets around financial services? Like, is the interest rate stuff cleared out? Is the regulatory risk cleared out? Are we risk on again? What are you seeing?
I wouldn't say we're risk fully on. If there's a dial, maybe it's at 6. I think unfortunately a lot of VCs got pummeled in the last 2 years. There's still a lot of aftermath there, and so I think the idea would be if the VCs had as much dry powder as people think they have, and they could actually use it, be more risk on. But I think, quite frankly, a lot of VCs are spending 80% of their time looking at the 150 companies they invested in, or 20 boards they're on each, and trying to figure out, how to throw life preservers and do inside rounds and things like that. So in a weird way, a lot of the, bar charts and things that we produce around, fundraising activity, it looks like the fundraising activity is like way off, but that includes a lot of big and medium-sized inside rounds that are, helping these companies bridge to the next world. So if you looked at the number of sort of later stage, call it $50 to $100 million plus rounds, there's, compared to what there were before, it's very few. So I really don't see us being that much risk on in the later stage, which is what you're asking, I think, environment. You did see Sum Up raise a bunch of money, and we've done a bunch of $100 million rounds as well for Worldcoin and Cart.com and Dunes and many others. But there's a lot out there in the world that are just not getting done. I think it's still pretty risk somewhere in the middle, not on or off. I think where it's maybe more risk on, which I'm really excited about, is in the sort of, honestly, like the seed and the A range, right? And that's a lot of the companies I think that are heading out to Fintech Meetup to think about their Bs. But what I was saying earlier is that the companies that are getting created are really not, consumer first businesses, or they're not businesses like you're not seeing too many SMB lending businesses where it's just purely, hey, find an SMB you never heard of and lend them $60,000 at 250% interest. I mean, you're not seeing these kind of like flimsier models get created these days because the VCs won't fund them, right? It's already pretty clear what didn't work. And I think VCs are, particularly after the fact, very smart to figure out what didn't work, right? And they're not going to do it again, right? So I don't think you're going to see a Root or a Lemonade or a Metro Mile get started, in this environment. You're seeing a lot of B2B2B, a lot of B2B2C, a lot of complicated software platforms that are really interesting. I'm not going to name names on all these, but I could. And, things that are, that look like they could be sustainable, that look like they're riding on, like I said, all the other infrastructure, but doing something really interesting. I think, look, there's some areas where it's risk on for some people, take like a Circle or something like that, where, things going through the roof, or a Worldcoin where we just raised a bunch of money, where, some portion of the world really believes in these 20, 30-year visions that these companies have, and the execution near term is really good. And you may not have everyone in the world jumping in, but you may have a small fraction of the world saying, I want to bet on this thing long term. And same thing with AI. I mean, there's a lot of people that are staying out of the super high valuation AI stuff, but there's like 5 or 10 or 20 VCs that are jumping all over it. So, but I think the wide lens shows a lot of pain below the sexiness of these companies that I'm mentioning, sort of the older school fintech companies that have been around, for 5 or 7 years. It got to 75 million of ARR, and now it's slowed down to 15% growth, and they're working on burn, they're working on shifting their models. Those are the firms that are having a really hard time, and that's 80-90% of fintech, in my opinion. And they're the ones that really need the help getting the capital, because the first 15 people on the Rolodex aren't doing it. So it's kind of best of times, worst of times situation, I think.
That's a very grindy position to be in, right? When your revenues are growing up and you're at profitability or better, and your financial models, what you promised, and then your multiple's gone down from 50x to 3x. And it's like, how do you get out of that?
Steve, I was just going to ask, I was reading the other day that I think 30 to 40% of companies, Series A and below, they're going to have to do some kind of raise. Obviously, with the cap tables being, often upside down, do you think this is going to be a catalyst for large-scale M&A over the next 12, 18 months?
It should be, but it won't be, right? There's a few threads there to pick on, I guess, Jon. It's a great question. I hope that there would be more M&A, because that's kind of our business. But the truth is that all these, if you're a Series A company that's struggling, maybe you find a buyer, but like, it's not going to be, the numbers aren't going to add up that much. And if you're JP Morgan or, B of A or someone like that, or Square, PayPal, you really don't have the time for these like very small, struggling Series A companies that can't get the Series B. So a lot of them are going to, either die on the vine or have to go raise more capital. There won't be a big M&A boom for them, in my opinion. And if you go up the chain a little bit to sort of C and D and E companies, if you will, a lot of people are saying that, they should all merge, right? And Chime, does X, Y, and Z really, really well, but they don't do a lot of lending. So maybe they should buy a lender. And, so-and-so has a full stack bank. Maybe they should buy something that does expense management, and start cross-selling, upselling. I personally think that stuff should happen. We did a deal with Acorns, who bought GoHenry, and it brought them into a whole new geography, a whole new category of products. But it was a very, very hard deal to get done, because when you're merging two private companies that have two different pref stacks, two different sets of valuations, two completely different sets of metrics, and two different egos and everything else, these types of transactions are very tough to get done. And you just have not seen that many private to private mergers where 1 + 1 absolutely should equal 2.5 or 3 or 4, but the parties just can't get the deal together. And I think that I believe we'll be seeing more of that, but not as much as you should. People need to put their egos aside and their wide bid-esques aside, and figure out how to make 1 + 1 = 3. Even if it's 0.75 plus 0.75 equals 3, you may not get your 1. you may not get credit for being 1, but you put 2 0.75s together and you can still make 3. So
that sounds like a lot of emotional math that's difficult to get right. There's so much more we can talk about, but we're coming up on time. I want to land our conversation in reflecting on the different sectors in fintech where you're kind of seeing near-term opportunity, either in there's more activity there, people are building more interesting companies, or there are more deals getting done, or it's the least mature part of the industry. Maybe, Jon, starting with you, if you look at the different tracks for Fintech Meetup, like, how are you thinking about the coming year in terms of prioritizing different sectors? Like, where do you see demand, and what are the major clumps that you're excited about?
Yeah, I think, Lex, if you'd asked me a year ago how much blockchain would feature at Fintech Meetup or on our agenda, or even as part of the kind of mind share of the industry, I'd have said not a lot. It's been hyped up so much. It's probably gone through 3 or 4 different cycles. It's still a solution looking for a problem. But I would say over the last 3 to 4 months, I've become more and more excited about what's happening in blockchain. Put crypto aside and separate it out completely. And the one example that I would use there is what JP Morgan's doing with JPM Coin and its relationship with Partior, its joint venture out in Asia Pacific. I think what they're trying to do here is actually solving a huge problem around correspondent banking. But again, rather than say we're going to completely replace correspondent banking, what Partior is doing is it's using JPM Coin with its liquidity partners and global banks to actually clear and settle much, much faster on the blockchain. So, I think those are the kind of really emerging major institutional areas that are getting real traction. And what I'm excited to see on that particular one is, okay, they started out in Asia Pac. When do they bring it into Africa, into Western Europe, into North America? And then you can start to see almost like the promise of what EarthPort was, which is global real-time on-chain settlement. I think that's really interesting. So that's one area that I'm personally watching pretty closely. The other areas are just generally, I think there's still a lot of innovation happening in payments. We're seeing a lot of early stage companies coming back into the market, trying to tackle, some of the perennial problems around wallet connectivity, real-time settlement, real-time reporting. We're set for a great event, and I'm really looking forward to it.
Steve, take us home. If you look at the market from a sector point of view, where do you think are the areas that are going to grow the most in the coming year? And then what are the ones that are still soft?
I think where I would take that question is not even looking at the different sectors. I would look at the different business types within all sectors. So, networks, for example, you really need to look at who's building a really, really valuable network in each sector, right? So within the world of, identity, not to keep harping on our friends at Worldcoin, but, kind of creating a global, network of identity mapping, can be massively valuable. If you look at a company like Freedom Pay, is creating a network connecting every single device manufacturer in the world with every single issuer, every single bank, every single processor, and potentially every single network like Mastercard and Visa to go the last mile between where Mastercard and Visa stop and where the merchant starts. I mean, these are some, really, really valuable networks that are going to be very hard to recreate. And there's a bunch more examples. So I look for networks, right, where it's, or like Athune's in B2B payments, that's really valuable. Then another area would be what I would call e-commerce enablement. So within lots and lots of different sectors of the economy, companies that are helping e-commerce go faster, go better with fulfillment, shipping, marketing, fraud solutions, like companies like Cart.com, ShopCircle, Ampla, and others that are really, really, helping to make other businesses, perform a lot better. So again, theme of riding on existing verticals that are successful, existing channels that are successful, but creating something to grease the skids in these other applications. I mean, certainly, I think for us anyway, and this doubles down on what Jon was saying, I think blockchain and crypto are going to be big for the next 20 plus years. I love that sector because there's so much innovation. It's still so new and misunderstood by so many people. And with all the, kind of, fear of regulation and all this kind of stuff, the large investment banks have pretty much vacated the space. They cannot take on mandates in this space. And we're being incredibly cautious about the types of companies and making sure that legal and regulatory and compliance and AML and KYC and the human beings behind all these companies are fully legit. You don't wind up with a bunch of, FTXs on the thing. We've had none of them, by the way. We see a huge hole there for investment banking. So because other investment bankers and banks just don't really understand or even are allowed to work in the space, we want to become the number one bank in blockchain and crypto. So that's the space we're spending a lot of time on. And then the last area, I'll take it home, is not so much a space, but geographies. We're now fully global. So we have a team that's focused fully on Africa. So, go to any coffee shop in Africa and ask someone about fintech. They're going to know FT Partners. We just spent a ton of time in the Middle East. So, and by the way, what an amazing region for fintech and growth right now. There's just been a couple multi-$100 million rounds done for newfangled high growth BNPL players. There's so much going on over there right now. We just got hired by an amazing company in Turkey, another company in Saudi that's in the payment space, and then India. India, people tend to forget about sometimes as being as big of an economy it is in the second, third, and fourth innings of fintech. So we really look to these other emerging markets, Southeast Asia. I mean, so it isn't all about what's going on in Silicon Valley or New York City or London or what have you. It's all these other emerging markets. And as a matter of fact, we're doing a big event in New York in mid-March for Africa FinTech. We're inviting over 20 or 30 super high growth, really attractive African fintech companies to New York and bring all the investors together in one place. So it's kind of like a mini fintech meetup of African fintech companies in New York. That's a high compliment, Jon. So, but it's a little different, obviously. But so we're doing a lot of that kind of stuff because we think the regions are really interesting. Some of the financial logistics companies in Africa are really, really high growth and interesting. And the verticals they're all interesting, but you got to find the 5 or 6 companies per vertical that are doing these types of things. And that's where it becomes really interesting.
Absolutely. I mean, this isn't a space that's slowing down by any measure dead, no matter what skeptics will say. And I think the entrepreneurial activity right now is absolutely amazing. I'm excited to hear you talk about blockchain coming back into attention after lots of stuff has gotten cleared out, because, I obviously spend a lot of time in that sector and looking at Europe and Asia for those ideas. So I'm really glad that it's relevant. And I also think that it's another one of these framings or labels that's just going to blend into the rest of the financial technology and financial services soup. And, 10 years from now, when we're doing the podcast again, all the words will be different and these distinctions might even be kind of quaint. Well, thank you so much for joining me today. It's an absolute privilege to have you here. Jon, if our audience wants to learn more about you or Fintech Meetup, where should they go? And then Steve, same question to you after.
Yeah, to learn more about Fintech Meetup, just go to fintechmeetup.com. It's March 3rd to the 6th at the Venetian in Las Vegas. We would love to see you there. To know more about me, you can just go to linkedin.com/Jon Lear, Jon Lear.
For me, it's ftpartners.com or email me, steve@ftpartners.com. And look forward to seeing everyone out there. And Jon, excited to be a big partner with you guys on Fintech Meetup. That is going to be one incredible conference. So thanks for throwing it and including us so much in that.
Looking forward to it, Steve. It's going to be great.
Thank you both for coming on to the podcast.
Thanks, Lex.
Lex, you the man. Thanks, buddy.
Hi, everyone. That's it for this week's episode of the FinTech Blueprint. For more technical deep dives into all things fintech and decentralized finance, check out fintechblueprint.com and grab a free subscription to the newsletter. This is Lex, and I'll see you next time.